Welcome to Cup of Joe for June 2nd, 2022. I'm filling in for Mike today. My name's Jason Pounders. I'm the marketing manager for Ryerson and Nick Webb's neighbor down the street. Hey, Nick, how's it going today?
I'm doing great. Yeah, and for those who don't know, literally straight over my left shoulder, probably about, maybe 150 yards away?
If that, yeah.
So yeah, hopefully Jason doesn't have a strong set of binoculars or anything.
I'm on the opposite side. But beautiful day in Chicago. Hope everyone is having a good start to the summer. I know we're glad it's summer in Chicago. Yeah, and hope everybody had a good holiday weekend. Nick, I guess no shortage of things to talk about. I know we chatted a little bit this week. Still a lot going on in the economy.
Yeah, no, I've probably got about, we'll see how long this takes, but I've got about 25 slides, which I'm going to cruise through some of them, but yeah, no shortage of things to talk about within the manufacturing space, the commodity space, a lot of differentiating data points that we're going to discuss here in the coming slides. But yeah, given the fact that we've got, we have no guest speakers this week, what I've actually done is I've included a couple slides on copper, which normally we don't discuss copper specifically, but I know a lot of our customers who are in the manufacturing sector, many of our employees may have some interest in copper as well. So we'll have that added in on the back end of the presentation, because I think we've got a couple interesting things going on there as well.
All right.
So with that being said, within this presentation, we are actually going to have a number of what may seem like investment advice or very forward-looking statements. We are here to tell you these are not, this is not investment advice. This is the opinion of Nick Webb, Jason Pounders. Do your own research. We're providing the best research that we can within the confines that we're able, but certainly do your own research. But I think we've got some really interesting data points that are at least good to ponder given the current circumstances we're in. So without further ado, we talked about this chart in the last couple months, but I want to revisit it because it seems like every economist and their brother is popping on TV saying low odds of recession, low odds of a recession. And for those who forget or don't know, technically a recession is 2 consecutive quarters of GDP negative growth. So negative movements in quarterly GDP. What's interesting is, even though every economist is saying low odds, low odds, low odds, we've already got one data point, basically 50% of the requirements, just using Q1 GDP data. So Q1 GDP, using the latest data points, came in at negative 1.5. So I don't know about all of you on the line, but if I'm looking at Q2 of this year relative to Q1 and some of the things that are taking place within equity markets, bond markets, the fact that we're heading into Federal Reserve tightening, I would almost make the argument that perhaps things are a little more difficult in Q2 relative to Q1, which would signal to me that maybe those odds of a recession are a little bit higher. Now, what I want to caveat that with is, I think a lot of times, and maybe it's just because of the last 2 that we've been in, I think a lot of times, investors and CEOs, they view the word recession as this 4-letter word that has to mean something that looks like 2008, 2009, or 2020. Those were very unique, I would argue, pretty cataclysmic recessions. They were certainly recessions, but it doesn't have to mean sky is falling, world is ending. And if we consider the possibility that Q1 and Q2 of this year are already recessionary conditions, which they may be as we roll through time and see how the data comes in, it hasn't been too bad for certain parts of the economy. I will dive into a little more detail on some of the spots of the economy where there has been some real pain, and again, I certainly want to be sympathetic to that, but broad-based, I think things are a little more mixed, and we'll get into the detail here in the coming slides on that. One of the key data points that is very, very mixed and is certainly really front of mind when we think about how the Federal Reserve is approaching interest rate hikes and how they're approaching inflation. It's the consumer. The consumer data right now is incredibly mixed, incredibly confusing. Some of the messaging we're getting from retailers and consumer discretionary type products is very, very mixed. And I guess to give a couple examples, Target came out, they had pretty poor results a number of weeks ago. But when you peel back the onion, what they noted was the fact that they may have just been poorly inventoried for what the consumer wanted, that they had more TVs and computers and things, big durable type purchases. Whereas the consumer wanted things like clothes to go back to work, clothes to go out in, purchasing of airline tickets. So there is a chance maybe we've got this nuanced flip of just what the consumer is spending money on. I tend to think that's the case. But what we're looking at here in this slide is on the left-hand side, it's the Consumer Confidence Index. So it's a survey done by the Conference Board. On the right-hand side is the University of Michigan Consumer Sentiment Index. And both of these are going back to basically, let's say 1970s-ish. And they're telling a very different story. So on the left-hand side, you're seeing consumer confidence actually at pretty elevated, well above average type levels. Whereas on the right-hand side, consumer sentiment looks about as bad as we've ever seen it. It looks easily as bad as some of the recessionary declines we saw back in 08, 09, even all the way back into the late 70s, early 80s. So kind of different strokes for different folks, depending on which survey you want to believe. But, I worked with my analyst on digging into how these surveys are constructed. And what we found was pretty interesting, because on the left-hand side, a couple of the key data points that drive consumer confidence are going to be things like employment, wages, which I think anybody within our economy knows we got a lot of job openings. Things are running pretty strong still, and wages are certainly ticking up. So if you contribute that to how the consumer's feeling, that makes sense that those data points would feed into a higher number. Flip over to the right-hand side, I've highlighted one particular item, which is the buying conditions of durables. So think about cars, think about big ticket items. No doubt about it, we've been in very inflationary conditions in some of those markets. And even though the consumer may be able to pay for those things, they don't really like the fact that they're having to pay as much as they are. Consider the fact that right now we've got airline prices that are probably about as high as they've ever been, but yet United Airlines just yesterday came out and said they're seeing absolutely no movement down in demand, despite the fact that ticket prices have gone up so substantially. So I think we've got this interesting scenario, at least within the core manufacturing world, of things are getting more expensive. Nobody likes spending more money on gasoline or plane tickets or things like that, but we've got more money in our pockets. We've got the ability to spend this, and still, even in this environment, we've got a lot of job openings, particularly within the manufacturing world. So pretty interesting scenario. Obviously there are some pieces of weakness coming out that I think we want to be cognizant of. One big one is certainly going to be on the Amazon side of things. So probably 3 or 4 weeks ago, Amazon did come out and say basically that they overspent, they overbuilt on warehouses. And now Amazon is in the business of either subleasing or selling. Their estimate is about 10 million square feet of warehouse space. So you do have some real actual pockets of weakness that I think we want to keep an eye on. But more broadly, the consumer looks like it's still able to stomach much of this inflation, even though they might not like it. Now, I'm going to give a quick plug to another podcast. It's nowhere near as good as Cup of Joe, I promise. But I listened to this probably a week and a half ago. It's an extremely good podcast. The speaker, Greg Jensen, he is one of the chief investment officers of Bridgewater, which Bridgewater is one of the biggest hedge funds in the world. Very intelligent guy, watches markets very, very consistently and effectively. And I won't spoil all of it, but there were a couple key things I wanted to point out. One was this idea that we may be moving into a world of durable production rather than efficient production. His argument is basically that for the last 30 or 40 years, North America has made a big stride towards being efficient producers of things, and much of what that would entail would be exporting of manual and physical labor and perhaps pollution to other countries around the world. What we're finding is, as the world's kind of sorting through whether or not it wants to be globalist or more nationalist, we're starting to figure out these supply chains are pretty sensitive. So he's kind of suggesting that perhaps we see some companies making more investments in local economies, domestic economies here within North America, which I think would be a positive for many of our customers. because that would entail more domestic investment, more manufactured products. Arguably, it could entail more expensive products ultimately because the labor and cost of things would be more. But that idea of durable versus efficient production, I think, syncs up really well with what our CEO, Eddie Lehner, has talked about in the past, which is metals matter. This idea of Andreessen Horowitz, which is a startup venture capital fund, he penned an article probably a year and a half ago called "It's Time to Build." All of these ideas are generally the same, which is, yeah, we want a futuristic world, but sometimes we have to reinvest in some of these old economy factors in order to get there. And we'll come back to that topic later in the presentation. Another thing that Greg talked about was potentially that commodities could be one of the best performers if inflation is deemed to be more persistent. I think even up to this point, I mean, just looking at stocks year to date, there's basically been one outperformer, and it's been, we'll call it commodities / energy for year to date performance. Most other stocks are trading somewhat poorly, and you can make that same correlation to kind of business conditions. So there is a potential that if we continue to see inflation ticking up the way it is, commodities may be a spot that continues to get support from a pricing standpoint, which I know that's a little bit of a bad news type scenario for many of our customers, but something to be cognizant of. I found this last little bit pretty interesting, which was Bridgewater estimates that 40% of publicly traded companies currently are cash flow negative, which his description of that is basically, it's kind of they need more buyers, they need more capital injections in order to survive. Otherwise, if you don't have those buyers or capital injections, you eventually tailspin into oblivion. And that's not to say all these companies are zeros, but it certainly could entail that there are a number of companies out there that maybe need to revisit their business case, their ability to be profitable, their ability to be self-sufficient. And I think we're in the process of seeing that play out pretty quickly. And with that, there is this potential analogy that perhaps we are seeing something similar to, maybe not identical to, but something similar to a dot-com bust and or 1970s stagflation, which stagflation is a fancy way of saying high inflation and low growth, which is not a fun combination to have. We've got a couple slides diving into each one of these. I talked about this last month, and I'm going to breeze through this slide, but we talked about the idea of the tortoise and the hare. Basically, the idea that you've got value on one side, or I would argue old economy on one side. You've got new economy, tech stocks, growth stocks. Perhaps you can make the generality that on the right-hand side, Cathie Wood and ARK Invest is representative, certainly more so than a Warren Buffett or the way he invests would be, certainly more representative of this cash flow negative group of companies. So these are companies that are growing top line. They could be very viable businesses, but if they're not making their own cash flows and the Fed is pulling away the punch bowl, some of these may need to downsize, lay off workers, become a little more efficient so that they can become self-sufficient within this market environment. So with that, I actually, over the last 30 days or so, I did a little bit of analysis trying to dive into this potential, it is not a guarantee, the potential that we're currently in a dot-com bust. So what we're looking at here is I've taken ARK, which is the ARK Invest Innovation Fund, and I've overlaid it against the NASDAQ. But what I did was I took the NASDAQ from 1996 through 2001. So it's the same 5-year strip. It's just basically 22 years, 23 years past. You don't need to be a stats major to visually see that these two things are extremely correlated. Even the peaks and valleys are to similar extents. It's pretty uncanny how similar they look. And I think ARK is a decent proxy for what NASDAQ would have looked like back in 96 through 2001, because at that time you had companies like Google, Amazon, eBay, which were kind of apples in our eye at the point. I mean, they were very young startup type companies. They likely weren't making profits at that stage. And they saw big run-ups because everything that had .com affiliated with it had massive run-ups. And then they realized, oh, we've gotten a little out over our skis. Things need to come back down to earth before we can take back off. So along the way, yes, there were bankruptcies. Yes, there were some very difficult times for sectors of the economy, but it wasn't wide based. So I guess I do kind of buy into this potential that we are seeing a little bit of an unwind of these high flying names that aren't generating their own cash flows coming back down to earth in a pretty quick fashion. So if we believe that to be true, and I know that a lot of this is talking about, stock markets and things like that, but I am going to take this back to commodities here in a second, which is if we believe that we are in a scenario that looks a bit like 2001 when tech stocks cratered, let's then do the same analysis and say, okay, let's look forward from 2001 to, let's say, 2005 or 2006 and see, well, if we believe that narrative that we are in a similar time, what performed well back then? Interestingly enough, when we look at the purple line, kind of that lavender color, or this orangish line, which is going to be the Bloomberg Commodities Metals subindex, the purple is going to be energy. Both of those commodity markets, and this is looking at it from a basket of commodities, I think that's worth noting, but both of them did over the subsequent 5 years outperform both NASDAQ and S&P. So there is a potential that, if we believe that narrative is holding true, there is a chance that some of these commodity moves that we've already seen play out over the last 2 years could potentially continue. I think we've highlighted over the last couple of months some of the structural and investment related constraints that the commodities world does have and looks like it may continue to have in some sectors. So who knows, maybe this is how it plays out. Again, I want to be very clear. This is not investment advice. I'm not telling you to go out and buy, metals and energy ETFs, but I think it's an interesting comparable, particularly given the fact that, I didn't mention this earlier, the correlation between ARK and NASDAQ from that same 5-year time frame is 92%, which for those who aren't stats majors, again, that just means there's a very tight relationship between the daily price moves of those two indices. Now, if you say, Nick, you're crazy, it looks nothing like the tech bubble, it looks much like something else. Well, another thing that a lot of economists and a lot of market participants are saying is, well, maybe it looks a little bit like the 1970s. Now, unfortunately, I wasn't alive to have lived through that. I talk to my parents all the time about that time, and it sounds like a very difficult, not fun time to be in markets and in some businesses, because that was a scenario whereby we had stagflation, which is, again, high inflation, relatively low growth. But interestingly enough, and again, I don't have the detailed data going into metals specifically, but we'll use energy stocks in this case as a proxy for commodities more broadly. If we believe that we're looking something like a tech bubble or like the 1970s, in both scenarios, the subsequent performance of commodities did outperform. So this is actually showing the performance of various asset classes on an inflation adjusted basis. So basically stripping out the inflation, which, all things being equal, if you have inflation and you're holding cash, net, you're kind of losing money because things are getting more expensive. So that's essentially what this is trying to tease out. But again, you see this commonality of, if we believe it looks like a tech bubble bust or it looks like 1970 stagflation, commodities generally look like they, on a relative basis, perform quite well over the subsequent years. Now, this may be totally off. We may be making poor assumptions. There may be much more to the story, but that I wanted to at least highlight that because in both of those analogies, it does equate to relative strength within commodity markets. Now, that being said, so that's kind of the bad news. Getting into the good news is, I thought this was an interesting way to show the data, because as you work your way down, you can start to see some of the ISM data points, and you can see over here in the actual column where those data points came in. So the headline ISM manufacturing data point, which just came in yesterday, actually increased month over month. So if you took a step back and you were listening to CNBC and listening to all the talking heads, you would have thought sky is falling. We have to be going into an instantaneous collapse in manufacturing markets. Well, the ISM surveys are not suggesting that at this stage. Not to say it can't come, but at this stage, we're not only seeing growth, we're actually seeing stronger growth on a month-over-month basis from the headline number. We are continuing to see prices paid at very elevated levels, although they are coming off very slightly. New orders, surprisingly, did tick up. Even backlogs of orders, which isn't shown here, but backlogs of orders did as well tick up. So there's a lot of positivity coming from the ISM data, which I don't think many were expecting. And I do think that that throws a little bit of a wrench in the Federal Reserve's plan, which was, I think they were hoping that they could more effectively and more quickly cool off the North American markets. And it's looking like, at least in the manufacturing space, things are a little more resilient than what they had previously thought. One other thing that I think is such a head scratcher is you've got these last two items on this screen, the JOLTS job openings, that's showing the number of jobs that are currently open and available for somebody to come fill. 11.4 million job openings in the United States right now. And in the face of that, you have the ISM employment actually going down, and not only going down, going negative. So make sense of that, where you have 11.4 million job openings and the employment situation within the manufacturing world is actually getting worse, not better. Not what you want to see. Certainly is proving to be much more difficult to fill these manufacturing jobs than what I hoped and what I expected. I will say that very quickly, given some of the downside moves we're seeing in a lot of these tech companies and startup companies, there are very quickly large numbers of layoffs. So perhaps, and I hate to say it's a good thing, I definitely want to be sympathetic to anybody who loses their job. I've been there before. But there is a potential where we could have a reallocation of those who are getting laid off. There are plenty of jobs out there that are available for hire. They may not look like the dream jobs these tech people and startup people wanted, but at least part of me feels not as bad to those who are getting laid off, because I know there are 11.4 million jobs out there looking to fill them. So pretty interesting data, I think, when you start to peel back the onion and look across the tech world versus manufacturing world. And then lastly, looking at similar data. So this is, again, looking at Purchasing Managers Index data. You can visually see it going left to right. There is an obvious, as we peel back and look at the global picture, there's very, very clearly a notable slowdown occurring. And I would say most poignantly in kind of the Eastern Europe and maybe Western Europe regions. Just visually, you can see it's a little lighter green in most parts of Europe, more yellows than we've seen over the last number of months. But then we look at North America, we look at the United States, we look at Canada, and we look at Mexico, and there's actually still some pretty strong strength within those manufacturing numbers. One other one that I do absolutely want to point out, because I've got one more slide on this, China, at least using PMI data, does look like, perhaps, knock on wood, the worst is behind us with regards to their lockdowns and their manufacturing activity, because they have come out of kind of orangish red territory and back into a more flattish type scenario. So there is a possibility, and there's growing belief that China is beginning to inch out of their lockdowns. They're beginning to open up their manufacturing facilities, and there's a chance we'll see that they continue to ease credit conditions and provide stimulus into their economy. They're already doing some, but it's not quite as big as what some were hoping for. But there is a potential scenario that I want to bring up, which is it does look like Europe is slowing down, and certainly Europe being a net importer of a lot of these commodities, they're not really self-sufficient in a lot of these. They're getting hit much harder on the inflation side of things than what North America is. And sadly, emerging market economies are also getting hit on the inflation side much more swiftly than what the United States is. But there's a chance that as Europe is seeing a little bit of decreases in growth and maybe even weakness, there's a chance that China actually picks up the ball for the back half of the year and provides support from a demand standpoint. Because the estimate from Goldman Sachs is that China being locked down over the last 2-3 months has contributed to 2.5% of crude oil demand destruction and about 10% of metals demand destruction. We'll see that in some charts here in a couple slides, but those are big numbers, and they do lend credence to the idea that if China does come back, those things can flip and would flip if they come back in a big way and stimulate their economy. So definitely something we want to keep an eye on. And when we look at the Chinese credit impulse data, it corroborates that story, which is, yeah, we're still coming out of the trough, but it certainly looks like China is beginning to reopen. They're beginning to put some stimulus into their economy, beginning to decrease mortgage rates, things like that for housing. So they're doing some things to try and re-incentivize and re-prop up their own local economy. And I think that makes sense, not just from the standpoint of you can't stay locked down forever just because that would be kind of crazy, but also for the political vantage point of President Xi Jinping has some pretty major elections coming up this fall where he's going to vie for basically a permanent spot within their government. So certainly from that vantage point, you would think that he would want to have his citizens supportive of his regime. And part of that could be stimulating their economy.
Hey, Nick, before you go too far, a PMI question. On Russian sanctions, do you think the PMI in Russia will continue to drop?
Well, so it looks like for now, the PMIs in Russia have kind of bottomed out. I'll come back to that slide here. You can see that really the weakest data point within the PMIs for Russia were actually back in March. And since then, they have even rebounded. Now, that could be for a number of reasons, but one main one would be the fact that that Russia is a large exporter, a large producer of a lot of commodities. And given the fact that a lot of commodities are much more elevated now than they would have been 6-8 months ago, their revenues from selling those things have increased. So yeah, weirdly enough, given all the turbulence, they actually are in a scenario, at least from a PMI standpoint, that things have actually recovered out of the worst case scenario. That can change quickly. And we can see that it's gone both directions over the last 4 months. But yeah, it's a pretty perplexing scenario. And yeah, I guess while we're on that topic, Europe did announce a couple days ago that they are making a phased out effort to try and wean off of Russian oil. It's expected to take place over the next 6 to 8 months, depending on the products and depending on the countries. But that is something that would likely have an impact on Chinese ability to monetize some of these commodities. But we'll have to wait and see how that plays out. That's pretty fresh data.
Okay.
Awesome. So getting into the actual commodities, we're looking at carbon steel here. So again, this is the United States price in white, the European price in blue, and then the Chinese price in orange. A couple months ago, you can see that Europe actually kind of led the charge higher on this second push up. That was all stemming from the Russia-Ukraine invasion. But similarly, Europe kind of figured out its situation. I mentioned the fact that Europe's also going through a little bit of a slowdown. So they're actually kind of leading us on the way back down as well. And you can see US prices are following suit. So where do we go from here? I've actually only got 2 slides on carbon just because it's been relatively quiet. I think some of the issues we see in a number of other commodities like energy, like diesel fuel, perhaps like food products, I would say is less of an issue within carbon. I think when we take a step back and we look at the production side of things within carbon steel, it may take time to get steel to various places, but we're not running out of it anytime soon. So clear heads are prevailing, prices are coming a bit back down to earth. And both of these charts, so the chart on the left and then the table on the right, kind of suggest we're going to land somewhere in a similar realm. And that is, let's call it roughly $900 to $1,000 for hot roll. So the futures curve on the left-hand side is basically saying we're going to be sub 1,000 by the time we get into late summer. And then over on the right-hand side, what we're looking at here is the first column is going to be the busheling scrap futures. So similar to hot roll coil, there is actually a busheling scrap futures market. It doesn't trade much, but it does exist, and we can use it to some degree to give a forecast of where traders think scrap is going to be. And if we use that scrap pricing, plug that into an electric arc furnace model, and I know historically we've used like $250, $275. I do want to give a little bit of, I guess I want to make a slight tweak to that model and suggest the idea that maybe $250, $275 might be a little tight of a spread that a mill should be willing to garner, because really they're seeing inflation as well. So, despite the fact that they're producing steel and they can probably do so profitably at 250. They probably don't want to. And given the fact that we have natural gas prices at very elevated levels, we have wages on the up and up, things like silicon are tight. You could make the argument that the historical spreads that we've talked about, 250, 275, might be a little aggressive. But if we apply a $300 spread or maybe a $350 spread to the current busheling scrap futures market, that gives you kind of a fair value, again, similar to where futures are projecting, somewhere in the mid 900s. And I think that's, knowing what we know right now, that seems like where we're heading. Maybe not in an immediate fashion, but it seems like we're going to drift down that way over the coming months, because again, those shortage fears that occurred specifically for Europe a couple months ago, they have been abated. Now, on the aluminum side, I would say in aluminum, and again, we talked about this last month, but Nick Webb loves charts. Looking at this chart here, I drew in this diagonal line, which the white diagonal line, which I would argue had been acting as support. You can see that every time the market got down to that level, bounced back off, it proved to be some support. Very, very recently, actually as recently as yesterday, the LME aluminum ingot price did dip below this line. So we are kind of at a crossroads. I would say that there are a lot of traders who are probably watching this line along with the other three lines that I've drawn on here, which are their gauges of momentum, the 50-day, the 100-day, and 200-day moving averages. All of them are kind of suggesting a similar thing, which is momentum in aluminum for now is relatively weak. I will caveat all of that by saying a lot of this weakness we've seen over the last 2 months makes perfect sense. We've had China in lockdown. If we revert back to that idea that China's lockdowns equated to 10% of global demand destruction, that should equate to lower prices. But we are currently in the process of potentially seeing China reopen, potentially re-stimulating their economy. This one's going to be one that I think we'll have to keep a very close eye on, not just in the coming months, but also in just a couple of days, because I think a lot of traders, a lot of people who go and hedge in these markets are going to be watching China very closely as it relates to this particular chart. Because if China comes back on full force and they're building a whole lot again and they're driving around, I would expect there to be some support in this market. Now, if they come out with a whimper, we could see this momentum trade continue to unwind. So again, I think we're currently right at a crossroads, and we're going to keep a close eye on this one to see where we head. But that being said, when we look at inventories alone, so this is exchange inventories summed up across the London Metal Exchange and the Shanghai Futures Exchange. This is going all the way back to 2003. You can see inventories on the exchanges have leaned out very, very heavily. So, and actually, even just in the last 24, 48 hours, you could probably Google search this. It's being discussed that some of the warehouses within China are not having as much inventory as what traders thought. So when traders are going to go pick up their physical ingots out of the exchange, they're finding that some of those units aren't actually there. I don't want to say that it's a fraud situation. I don't want to say that it's a mismanagement issue, but some of those headlines are beginning to raise some yellow flags, I would say, at this stage. Because if people thought there was more metal in the exchanges than what there actually is, perhaps we have a tighter market than what was previously perceived. So again, not trying to shout fraud or anything like that, but if that is to continue to be a theme in the coming weeks, you could see a scenario whereby you see people maybe not panic buy, but certainly become a little more active buyers because things are tighter than what they previously thought. Now on the stainless side, a little bit of a different story when we look at the nickel markets. Of kicking around launching their own competitive contract to the London Metal Exchange. So I apologize if I chop up at all. I just got a notification that my internet connection is a little weak. But so as I look at this chart, certainly momentum is waning back to the downside, it appears. As we look at the 200-day moving average right around 1070, that would kind of put us back down to a pre-squeeze type pricing level. In my head, that's kind of where I think we're maybe heading, but we'll have to wait and see. We have seen some small instances over the last couple of weeks of mini short squeezes where on no news, the market jumps 11% in a couple of minutes. So it's just a very fragile, discombobulated market. It's not a great situation. Unfortunately, we get that has implications on stainless steel prices for now, but it's the function or the mechanism that we're all subject to at the moment. And this is the chart showing the trading activity in the nickel contract, which it's come off, let's call it 25-ish% just since that squeeze occurred. So a lot of traders, like I've said in the past, they're probably suing the exchange. They've left the exchange in total and said, I'm not going to trade your products anymore. They're pretty upset that the exchange closed down the market and canceled trades, because those who were on the long side or the bullish side of the market, they got a lot of money taken away from them, most likely. So you can understand their frustration. Lastly, on the surcharge side, probably no secret at this point, but natural gas has really kind of joined the charge with a lot of other commodities. So they've actually jumped in the last, basically year to date, by a little over double. So they were about $4 per MMBTU beginning of the year. We're up closer to $9 per MMBTU. It's a lot of the same thing that we're seeing in a lot of different markets, which is energy markets, whether it's clean energy or fossil fuels, we're tight. We're tight on energy units around the world, and that's affecting crude oil, diesel fuel, gasoline, natural gas, even coal. Coal markets are trading up around record high prices in certain regions. So it's the energy scenario has unfortunately not been fully figured out at this stage, but and unfortunately for surcharges, we've gotten up to a level above $6 per MMBTU, where the domestic surcharges will now have an extra component for natural gas. So it's not going to be big. My expectation is, so for May, it was about a half cent. And then for June, given where prices settled out, it's likely going to be right around 1.3 cents. So not going to break the back, but it is going to be an incremental adder onto stainless surcharges, at least for the next couple of months, it seems. Now, I promise I am not a fanboy necessarily of this Odd Lots podcast. And again, it's not nearly as good as Cup of Joe, so don't spend too much time there. But if you're going to listen to two podcasts within the Odd Lots basket, if you will, the last two that they have on there, they did one, it was either yesterday or 2 days ago, with the head of metals at Goldman Sachs. His name's Nick Snowden. And now the headline's a little hyperbolic. It says, why copper may be one of the tightest markets the world has ever seen. And you might be trying to grab some headlines there with that one, but I think it's an interesting one and an interesting structural issue that I think we should talk through, which is the overarching basically summary of what they talked about was the fact that unlike some things like growing corn or producing crude oil from shale, which, as I understand, it can take 3 to 6 months to bring shale production online. Things like copper, things like nickel mining, those are much longer duration projects to get them from, hey, I want more copper, to, hey, we're actually putting copper out into the world. I actually compared this to my analyst to making bourbon. I don't know how many of our viewers on the call know much about distilleries, but when you start a distillery, oftentimes they don't start with bourbon. And one of the main reasons why they don't start with bourbon is because by nature of how you make bourbon, it's got to be aged for a number of years in an oak barrel. So who's going to plop down all that money to build a new distillery and just sit there for the next 5 years while their bourbon sits in barrels and they can't make any revenues? Somebody might do it if they have a ton of cash. But oftentimes what distilleries do is to close that gap, they'll actually start producing shorter lead time distillates. Distillates make it sound like it's a crude oil product, but spirits. So vodka, tequila, gin, things that they can push out the door on a much quicker basis. All the while, the bourbon is sitting behind the scenes, aging, getting ready to be put into the market. that's kind of what's going on, or at least that's what Goldman is proposing is going on within the copper world, where for the next year, 2 years, let's say, it looks like investment in new copper facilities is actually ticking along pretty well with demand. And you can see that in the chart down below. That's going by year. It's basically showing the relative trends of supply with demand. And as we should all know, we would want those two things to be coordinated. You want supply to be in line with demand, or in a better scenario for all of our customers, you would want supply to actually outpace demand, because then you could bring down prices. You'd have more than what you need. Now, what they're depicting is a scenario whereby, unfortunately, it sounds like there hasn't been a lot of new investment, or there aren't plans of new investment going into 2026 and beyond for copper. So this is pretty long lead time type stuff. But if we believe their demand forecast, and if we believe that new copper mines aren't being invested in right now, you get kind of this alligator mouth where demand growth over the forecasted next 7 to 8 years is expected to grow and grow and grow, and we don't have supply to meet that. So that creates a real constraint. And I will caveat this by saying, anytime I see a demand chart that looks like this and just kind of straight lines it out in the future, I oftentimes question it and say, no demand curve ever works out quite like that. But we have to make some assumptions here. And if we assume that electric vehicle growth is going to continue, if we assume that the ESG trend of electrification, wind energy, hydropower continues, the argument here is that from a demand side of the equation, you've got this whole new market that's going to require a lot more investment into the electric grid. You can't really get electrification without more investment in the electric grid. And with that investment, you're going to get more demand for copper. And if we don't have investment taking place, coming back to that bourbon analogy, if we don't have that investment in copper taking place 5 years before it's being demanded, you're going to wind up in constrained scenarios. And what happens in constrained scenarios is prices can go to the moon. You basically get a short squeeze. And now, again, I do kind of want to caveat this whole projection with, if we end up seeing copper go from $4.50 to, they actually mention in the podcast, $25, $50 per pound. If copper goes to $50 per pound, I'm going to guess you're going to have demand destruction. People are going to find alternative sources of electrification. People are going to stop pushing for electrification. Somewhere in here, you're going to have kind of a broken market if this is how it plays out, because copper going to $100,000 per metric ton does not bode well for the green electrification future. So something here I think is probably going to change, but as we sit here right now, it is a pretty interesting dynamic and a pretty interesting proposition for maybe the 3 to 5 year, 7 year horizon for where copper prices could go. In the short term, again, it's looking like we're fairly well supplied. So this is a pretty long-term forecast, but I thought all of you would find that pretty interesting. If you dive into the podcast itself, he goes into much more detail than what I just did, but that's the general idea here. So it could get a lot of these themes we're seeing. I mean, 2 years ago it was steel. We didn't have enough steel and demand was coming on at a faster clip. Now we're seeing it happen in energy in a big way. This is the proposal that if it happened in copper over the next 5 years as we try and electrify our world, it just seems like a big whack-a-mole for commodities and manufactured goods is taking place across the board. So there are a lot of things we got to be discussing and hopefully investing in soon before they become bigger and bigger issues. On the pricing side of things, again, Nick Webb loves charts. There's a technical pattern that some technical analysts reference, which is called a bull flag. And the idea behind a bull flag is that you basically got a flag pole, and you can kind of see that in this 2020 into early 2021, the big sharp move higher, and then a large amount of consolidation. And when I've kind of highlighted it to make it look a little like a flag, but you can see that it sort of does look like a giant flag waving in the wind. This is generally, at least in a technical analysis standpoint, viewed as a fairly bullish chart pattern, because it's the idea that you've had a big run up for some reason. The market's kind of cooling off a little bit, trying to digest and consolidate, take a breather, and then perhaps the trend continues at some point after you've gotten the weak hands out of the market. I don't know for sure if that's how it's going to play out. And certainly we tested this fairly closely back in, let's call it March, April, when China shut down. We came down to the low end of this flag, if you will. Very quickly in the last couple days and weeks, as you can see, copper prices have recently jolted back up above the 50, 100-day, and 200-day moving averages. So I think a lot of that is probably coming from the expectation that China is going to come back online. They're going to rejuvenate the demand for copper. And at least from a technical and momentum standpoint, it's kind of back in gear at this stage. So we'll see how it plays out. I mean, obviously, we've got some headwinds coming from Europe. I think we've got some headwinds coming from North America at the moment. But as some economists like to say, copper's got a PhD in economics. And right now, that PhD is saying things are looking a little better than they were a few weeks ago. So with that, we will open up for Q&A, or if Jason wants to fire anything my way, we are all ears.
So any updates on import tariffs from China, and how's that playing on the markets here at home?
Yeah, I mean, there's certainly discussion taking place. I mean, I think the administration currently is trying to look at literally all options. And when I say all options, even as recently as yesterday, there were some suggestions, although not widely confirmed, that we were even discussing buying additional crude units from Russia. Now, I'm not saying that's going to happen, but it sounds like they're kind of checking under all rocks for ways to dampen inflation. One very quick way to dampen inflation would be to lift tariffs to some capacity against China, because as we all know, when we don't have tariffs on China, they've got some pretty cheap product and pretty cheap manufactured product that can be purchased. No definitive answer yet on whether or not anything is going to take place. Everything I'm hearing is that with respect to 232, no changes are expected. Perhaps something on the 301 side, but nothing definitive at this point.
Okay. So with home sales slowing down and inventories maybe increasing in home appliances, do we see impact on stainless markets?
Yeah, a little bit. I'm seeing mixed headlines. I mean, I think within Ryerson, within our base, we do talk to some appliance manufacturers, and from what we're hearing, lead times and backlogs are still quite extended and maintained, that there aren't a whole lot of order cancellations. We've heard from some other data providers that the feedback on the consumer side is a little softer, so some weakness there, and perhaps building of inventories. I think coming back to our original discussions about the strength of the consumer, or what is the consumer buying rather, is potentially playing its part within the appliance sector, because I know we've talked about this in some prior podcasts, which is when lockdowns occurred, a lot of people invested in their homes. A lot of people took those stimulus checks and they bought new appliances. They bought stuff. They bought TVs. Those are the things that Target kind of referenced in their last earnings call as being over inventory right now. That's not to say that the consumer is bad. That's to say the consumer doesn't want appliances anymore. So yeah, if home sales weaken, if home remodeling weakens, yeah, there would be some weakness incrementally on the appliance side and on the stainless side generally. But I'll say flipping that on its head, there are other manufacturing spots that actually are holding up quite well, and maybe even are arguably being held down artificially, namely automotive. Automotive data came out yesterday exceptionally weak, and it's just never gotten out of the doldrums because of its inability to finish producing cars due to semiconductors and other parts. So there's a chance, similar to China kind of taking the ball from a weekend in Europe, you could see a scenario whereby at some point automotive actually gets the chance to finally produce the way they want to produce, and we could see automotive production take the ball from appliances, something like that. I can see making sense.
Yeah, it's going to go somewhere, one way or the other, right? The way it is now.
That's right.
Yeah. I think that's all the questions. I guess any closing thoughts? We're getting a lot of mixed signals. I think you help kind of clear up some of the stuff that you and I talk about. But yeah, anything to part on?
Yeah, I mean, I think we're going to see a ton of volatility in the coming months, and we're going to see a lot of very differing rhetoric coming from the Federal Reserve as they're trying to incite fear into the markets and hopefully dampen inflation to some degree. My gut feel is that I think we will see prices of some things come down. And certainly it seems like there's a shifting of consumer preferences that's taking place. But there are some structural things, unfortunately, like diesel fuel, like natural gas, that look, and like food products that look like they are going to be hard to fix with interest rates and with balance sheet reductions. So, those things are going to be a little painful. So it's going to be an interesting summer, a lot of volatility. To the extent any of our customers want to try and address volatility, we have the ability to fix pricing. We're certainly not condoning that now is a perfect price level to do any of these things, but to the extent stability is something that our customers value, we have the ability to help in some of those things. So speak with your salespeople, or talk directly to myself, and we're happy to help on those types of things. But yeah, it's a lot of things going opposite directions right now. It's pretty interesting times.
Yeah, for sure. Well, be sure to tune in next month, first Thursday in July. We're going to have a panel of vertical market managers. We're going to talk about manufacturing in the U.S. So I hope everyone can join that. As always, this will be on YouTube sometime maybe tomorrow or Monday for sure. So if you can't catch this live or you want to rewatch this, be sure to check it out on YouTube and subscribe to our YouTube channel. Again, thanks everyone for participating in Cup of Joe. We appreciate your interest and your time. And with that, we'll say goodbye. Thanks everybody. Thanks Nick. Thanks
everybody. Have a great summer. Talk soon.
Bye.